Welcome. My name is Kate Schindel. I'm the president of Actors Equity Association, and I'm so excited to see all of you here. As you probably know, we've done these types of seminars in the past, but this is the first time that we've ever attempted both a simulcast with LA and Chicago, and then also to preserve it and put it up online for our members to access who couldn't be here in person. And I'm really, really happy that we're doing that. It seems like a great step in a really positive direction. So thanks for coming. My name is Kate Schindel, and I'm the president of Actors Equity. This seminar, just so you know, is sponsored by the Equity Membership Education Committee and presented by Sandra Karas. Ms. Karas is a working actor and currently serves as Secretary-Treasurer of Actors Equity and on the New York local board of SAG-AFTRA. Additionally, she is an attorney in private practice in the areas of tax, financial planning, estates, trusts, contracts, and business law. Wow, she's impressive. She serves as director of the Volunteer Income Tax Assistance, or VITA program. A number of you have probably been to that. Yeah. It's astounding what they do on an annual basis, and we couldn't do it without Sandra in any way that I am aware of. So we're very proud and grateful to have her service in that respect. She holds licenses in the areas of tax accounting, securities, investments, and the law, and is admitted to practice in all New York State courts, Federal District Court, United States Tax Court, and the United States Supreme Court. Thank you all for coming, and here's Sandra Karas.
Thanks, Kate. Thank you very much. That would be, my turn to say, hi, I'm here all week, and I'm actually here next week, and the week after that, and the week after that, and the week after that, until we all turn into pumpkins on April 15th next door. Hello to everyone in Chicago and Los Angeles. I'm going to be occasionally looking up at this monitor. So those of you in the New York council room are going to see me keeping an eye on the other offices, because as Kate and Tom told you, this is the first time that this is simultaneously presented across the three regions. So, this is a great experiment for all of us, and we hope it works very well. My goal today is to present to you how to organize to get your taxes ready, what is deductible, and what kind of substantiation you need to survive an audit. I want you to know we're here for you. We're here year-round, and if we can't help you, probably no one can. So, we really have been doing this a very, very long time, and we serve members of the entertainment industry exclusively. So, you're our babies, and we're yours. This is a member service. I'm one of you. I'm not here soliciting any business. We offer this for free, and we're really, really happy to serve our members. As far as I'm concerned, and anyone who knows me knows I believe this wholeheartedly, the better educated my fellow members are about their own finances, about their taxes, about their money lives, the happier I am, because it makes you a more informed, not just a more informed taxpayer, but a more informed actor. You want to be able to have control over your lives. And what part of your life is more important than your financial life in many respects? Because a lot of times when things go off the rails, it's because of money. It's not because you don't have a great squeeze. It's not because, you don't have nice parents or great friends or, all of that. It's because of your money. So we want to help you get control of it. And we think that some of this today will help you get started. So what I'd like to do is, let's see, what else did I say? Worksheets, website. Good, I said it. Good. Great. You have 4 worksheets today. One of them is a 2-columned checklist. I call it the information checklist, but it doesn't say that on there. That's just what I call it. How many of you have ever gone to a professional tax preparer and gotten an organizer sent to you the following year? And it's about this thick, am I right? It's about 3/4 of an inch thick, that several trees were harmed in the process. How many of you have seen that, right? Yeah. I have synthesized everything from an organizer into one piece of paper, front side only. I'm so proud of this. Well, it took me 30 years, but I did it. And so we're going to go through this. It's going to show you what you need to organize, what is reportable as income, what's allowable as expenses or deductions, And then we've got, this is the money shot. This is what you all came for. The theatrical expenses, showbiz expenses, what's deductible. And we also have an out-of-town deductible expenses for when you're working or looking for work, requiring an overnight stay. And last but not least, for those of you in automobile towns, we've got the automobile worksheet. So as I said, it's an ambitious amount of material to get through. I want to get started. And as I said, if you can't understand me or didn't hear what I just said, I don't mind a hand going up. But otherwise, I'm probably going to ignore questions until we get to them. So thanks. So let's start with the 2-column checklist here. Now you'll notice all of these worksheets are geared toward the VITA program. They've got volunteer income tax assistance on the front. So now let's get back to this worksheet. On your left-hand column, you see kinds of income. And all these kinds of income are what the IRS and your state agency expect you to report on your tax returns. So let's go through them. W-2 forms, W for wages. Your W-2 forms are sent to you by your employers. These are people with whom you've worked, or for whom you've worked, I should say, as an employee under contract, right? And it doesn't have to be in showbiz. It can be anywhere, right? It could be, in a law office, at a restaurant, dog walking, whatever it is you do where you toil as an employee can be reported on a W-2 form. Now, what we find in our program is that a lot of people don't know if they've gotten all their W-2s at the end of the year, because we have people, some of them get, 10, 20, I've done as many as 29 W-2s on the same tax return. So, it's you can really be pulling your hair out if you're trying to figure out if you've gotten all those residual W-2s or any of the other payments where you've worked as an employee. So the best way to organize this for you is that I would recommend you always save your last pay stubs, right? All your pay stubs, actually. But when you get to your last year-to-date pay stub, it'll tell you who paid you, what they paid you, when they paid you, what they withheld, and that should be a record that you have ready for when your W-2s start rolling in. And they've been rolling in now for a couple of weeks, am I right? The employers, are they a little late this year? Yeah, well, we've heard that too. Employers have until January 31st by law to get the W-2 forms and other income statements in the mail. So you will see things trickling in the first week, maybe even the first 2 weeks of February. Now, I'm going to ask you this question here. At this juncture, have you given them your current address? Do all of your employers know where you live? Did you move and forget to tell someone? That is the most common reason why people don't get a W-2 in the mail. And they don't know why. They say, I never got it. I just never got it. And I say, do you move? Yeah, I moved. I said, oh, that's why you didn't get it, because they don't know where you are. And it probably was returned to the sender. So if you have changed your address, contact your last year's employers now, even if they've already sent out your W-2 and request a duplicate. So what's the best way to organize? Well, you're going to go back through all those pay stubs, aren't you? And you're going to say, well, I got the one from Entertainment Partners, I got the one from Cleveland Rep, I got the one from this, but I didn't get this one yet. So I'm missing a W-2. And that's the time to either call them, doesn't hurt to call, and say, have you sent it out yet? And some of them even have an online presence. So you might be able to access your W-2 form online if they allow you to do that. Some do, not very many, but some do, and pull up your W-2 right then. Some are willing to, just send it out in the mail again. Some will ask if you want it faxed to someone, that sort of thing. So don't be shy, but don't wait until late February or early March and say, gee, I never got that W-2, because you can't do your tax return without it. We can't do your tax return without it. So get on the stick now and look for these things. 1099 forms, there are lots of them. 1099 INT stands for interest. If you have earned interest in a bank account, a brokerage account, or a credit union, credit unions actually call them dividends because credit unions are cooperatively owned. But the IRS treats credit union dividends as interest. So, did you get all your 1099 INTs this year? What if your interest was lower than $10? Well, if it was, The payer doesn't have to send you a 1099 by law. They can just say, nah, we're not sending it out. Congress said we could, save a tree here with this. Do you still have to report the interest on your tax return? Yes, you do. Yes, you do. So where's the best place to get that information? Your December statement. It's usually the easiest place. If you've got, $6.78 from the credit union or from Bank of America or wherever you do your banking, then that's the place to look for it. So I'd pull up my December statement and look at it, and if it indeed is under $10, you're not going to be waiting for a 1099 int. 1099 div, same thing. Dividends, but these are from brokerage houses, investment houses, your mutual funds, your stocks, and so on, send you dividend statements. And very often you've gotten dividend payments during the year, but sometimes you haven't. So if you haven't, that's okay. You still will get these credited to your account. And if you haven't seen it, if you haven't seen them yet, you should start asking. Now, Congress some years ago decided it was going to give a big break to investment houses and say, well, you guys can get around to reporting sort of whenever you want. Too big to fail, too big to report. That's what I say. So, what do you do with these guys? Well, you can look at your December statement and you can see if your dividends were less than $10, you're done. If they were more, you probably want to wait for your 1099 div to arrive in the mail and find out from your broker. Now, very often they have an online presence, and you can go on and get those 1099 divs right online. So the more proactive you are in assembling your income, the better prepared you're going to be. 1099G stands for government. Unemployment compensation. How many of you have collected unemployment benefits this past year? A lot of you, right? And so you're going to be looking for those. Very often the states will allow you to go on their websites and get those 1099Gs right online. New York does it. Several other states do. But they're supposed to also mail you one. The other 1099G forms you're going to get are for your state tax refunds. So last year when you filed your return, you got a refund from Connecticut and from New Jersey and from North Carolina, and you owed Michigan a few dollars. And so this year you're going to try and reconcile all those state taxes, and you're going to be looking for 1099Gs. Well, guess what? New York doesn't send them. Usually the other states do. New York does not. They say, oh, you want your 1099G for your refunds? You got to go online and get it. That's the rule. So you either look at last year's return and you say, yes, I did get that refund, or you've made a note somewhere, or you go online to tax.newyork.gov or whatever your state is, and you look it up that way. California is pretty good about it. Illinois is pretty good about it. Pennsylvania is good about it. Maryland's good about it. Most of the states are. New York is a real pain in the neck. No surprise to you guys in the other cities. So 1099B stands for broker or barter. This is for those of you taxpayers who trade commodities in some way. You either sell investments, you sell stocks, securities, mutual funds, and you've had these funds sitting around. Sometimes they were a gift from grandma. Sometimes they were little investments that you got when your parents maybe invested something for you, or you bought something at some point because you thought it was a good idea. And you've got these investments sitting around. Well, if you sell them, if you decide to sell them, the Internal Revenue Service and your state agency is going to think that whatever proceeds you got are fully taxable unless you tell them otherwise. And the otherwise is, when did you buy them? Or the asset, right? When did you buy it? What did you pay for it? Or when did you inherit it? And what was it worth when you inherited it? Now, this can be a big pain in the neck. You're thinking, really? I have to know all this stuff? I have to know what it was worth when my grandmother died? And I got, yeah. Essentially, yes. Now, there are some great historic sites where you can go and look up value of stock shares, and I mean, they're great. They're, I use them all the time. And you can find out what the stocks were trading at on any given day, including the date of your grandmother's death, if you don't have any other way to find that out. The other thing we have to know is something called the cost basis, not just what you paid for it, but did you reinvest a lot of dividends over the years? Well, the good news is They might be too big to fail, but they're not too big to be forced to tell you what your cost basis is, which is great. And this year, for the first time, I think they all have to comply. It's been happening over the last couple of years, but the brokerage houses now have to provide you with a cost basis if they have it. Right? What if they don't have it? What if you were at Smith Barney for several years and you decided to go to Merrill Lynch? Well, Merrill Lynch isn't going to know what your cost basis is, but Smith Barney will know, won't they? So you might have to do a little bit of historical digging on your own, but just so you know that there are ways to find this information out, and your tax preparer, whoever that is, especially we at VITA, are going to ask you these questions. They're going to say, well, you sold your IBM stock for $5,000. What's the basis on that? We need to know. And you're going to say, gee, I don't know. And if it's zero, you have to pay tax on $5,000. But if it's $4,000, you only have to pay tax on $1,000, right? So you want to know what the original investment was and what the basis is if the dividends were reinvested. I don't want your eyes to glaze over too much about this because, as I said, these are things we can go into in greater depth if you call the office or if you check with your own particular tax expert if you're using a paid preparer. Yes, sir.
I just want to make sure cost basis, that really just means what the original cost was when you acquired it.
Okay, the question is, what does cost basis mean? Cost basis means the original cost when you acquired it, right, what it was trading at on the day you bought it, plus any reinvested dividends that you might have authorized your broker or your advisor to put back into the fund. So if you're not getting your dividends mailed to you, you say, oh, just reinvest them, right? So, you inherited your IBM stock or you bought it for $1,000, but over the years you've reinvested, another $2,500 of dividends into it. Well, now you have a cost basis of $3,500. If you sell it for $5,000, you know what that cost basis is. And as I said, if you've traded brokers here and there, you have to remember where the cost basis began, because those are going to be the only people who can tell you historically what happened before you moved it. And sometimes these are real mysteries. We do real detective work trying to figure out, was it at Smith Barney, then back to Merrill Lynch? No, you don't like those guys. You went back to Smith Barney because they were nicer. You got to cobble together a lot of pieces of history. But if you have this, if this situation applies to you, know that you're going to have a little homework to do. 1099 miscellaneous. You all get these, right? Yes, this is where you say, oh, I have to do a Schedule C, right? Probably. Miscellaneous is miscellaneous income, and it can come from royalties, it can come from rents, but it usually comes from non-employee compensation, which means that you're treated as an independent contractor for whatever that gig is. And there are some legitimate independent contractors. Where we see them in our industry are directors, choreographers, composers, lyricists, playwrights, designers. Who else? Those are teachers are not typically. Oh, you mean if you have your own studio? Okay, the comment from the back of the room is teachers. If you have your own studio, yes, and you offer private lessons in whatever field you offer it, vocal coaching, dance, scene study, monologue work, whatever it is. Yes, if you have your own studio, but chances are good your students or pupils are not going to send you a 1099. I'm talking about the kind of gigs that you usually end up at the end of the year receiving a 1099. But both sources of income are taxable, right? Yes. So if you're offering private work, even if you don't get 1099s, all of that income is taxable as self-employment. But if you've been doing gigs around town, you sing at a church here and a temple here, and you do some choreography with a group, and books on tape that you generate from your house, right? You work in your house, you have your own studio, your own equipment, and you send everything digitally. You're self-employed. You're going to get 1099s. So, again, how do you know if you've gotten all your 1099s? You look at your pay stubs. The good news about 1099s is they don't have to be received before your tax return is filed, because so far Congress doesn't care about looking at those. They have them on file from the payers who've sent them to them, but you don't have to attach them in any way to your tax return. So we just ask you, well, how much did you make at this synagogue last year singing? Say, well, I made $950. Well, if that's what you made, and that's all you made, you can just simply report it. You don't have to wait for the 1099. But if you're looking for them, and if you've got a pay stub, a check stub that says you earned some money as an independent contractor, then it's important for you to reconcile those to make sure you've got them all collected and all understood. 1099-R, retirement, pension, retirement, IRA distributions, 401k distributions, all of those kinds of payments that come when you take money out of a qualified retirement account. You don't have to be retired to take money out of those accounts, right? I mean, some people take them out long before they're retired, and they can pay some penalties on them if they were deductible plans when the money went in. So don't be surprised if you invaded your 401k or you invaded your IRA for some other purpose. And there are some exceptions to the penalties, but if you have to pay tax on it, don't be surprised. Some people are, and they say, gee, that was my retirement money. How come I have to pay tax on it? Well, because it was deducted originally. Now, the Roth IRA is an after-tax IRA, and that's not a deductible IRA, but there are still some limits as to when you can get that money out as well. So, as I said, any questions about this stuff as it applies to you, you can either ask later or you can see us at VITA. Alimony receipt, 1099 SSA, Social Security monies. If you collect Social Security, you're going to get a pink and white form that has a 1099 SSA on it, and it'll report your Social Security, your Medicare B insurance payment, and any federal withholding you might have on it. It's a big form. So it's a cousin of all the other 1099s. Alimony received, not child support. If you collect maintenance payments, as they're called in New York State, alimony in some other states, you have to pay tax on that money. It has to be specifically characterized that way in a separation agreement. And we don't really see that very often. Once in a blue moon, we've got somebody who's collecting alimony. Sale of your home. Why do we need to know whether or not you've sold your house? Because you might have taxable gain. If you're a married person filing a joint return, you can exclude up to $500,000 of gain on the sale of your house. If you're a single person, it's half that, $250,000. So you can buy a piece of property and live in it for a long time and sell it, and if your gain is not higher than those, you have no taxable gain. But we have to know that, because if you get a statement from the title company or the closing office that says 1099-S, you sold a house, we have to know what the basis in that house was, right? Same thing. How much you paid for it and what you put into it, right? What you invested in it, capital improvements. Again, these are things that we don't see that often, but when it happens to you, it can really be shocking because you don't know what to do with it. And you need a lot of documentation to complete that tax return. Let's see, what's next? K-1 forms. How many trust fund babies do we have here? None. Gee, too bad. Well, I know, I was going to say, you know who you are. So yeah, you know who you are. You're not kidding me. They just don't put their hands up in these seminars. If you get money from a trust, if you're the beneficiary of a trust, or you are a shareholder in an S corporation or a partner in a partnership, or you are the beneficiary of someone's estate. Grandma died, she left you the stock, she left you whatever else, a couple of things, maybe a car, I don't know what she left you. But it's going to show up on an estate tax return that will kick out a reporting form for the individual, and that reporting form is a K-1. And sometimes we get people who walk in and say, what is this? And we say, oh, who died? And say, oh, my aunt. How did you know? And I go, well, it's an estate K-1. Sorry for your loss. So let's see. And then we can go through that. Now, very often, most often, these forms do not arrive in the mail until the end of March or early April. So if you think that there's any chance that you're going to be receiving a K-1 form, for some reason, and those of you who are in partnerships and S corporations already know this drill, or trusts, you know that already. But those who are beneficiaries of an estate often don't expect it, and they come in and they say, "What do I do with this?" And we have to amend the return. We'd rather not do that. We'd rather not amend returns. So find out ahead of time if there's anything that you're going to have to be reporting, and they'll let you know. Rental income. How many people here are landlords or participate in Airbnb? Oh, we have a few. Okay. Anybody? No? No hands going up there? Yeah, I don't see any. So you guys have a big responsibility in that you not only have to report all your rental income, but you've got to, in some cases, calculate the depreciation on the dwelling, all of the expenses to operate it, and so on. And it's a very involved part of a tax return, but we do them. We see them on a regular basis, though we don't see a heck of a lot of them. So you'll notice here it says bring rents, basis, expenses, etc. It's just kind of a laundry list, Just bring everything. If you're a landlord, you're on notice that we're going to need a lot of information from you. Disability income. Disability income is something that you get that's actually paid for by your employer. That disability insurance that's on your W-2, it's like $31, or in California, it's like $68, or in Jersey, it might be, $25, whatever it is. Every state has a different amount for disability. But do you ever see that there? It says DI or DIS or CADI, NJDI, those kinds of things. That's what your employer paid in from your money and her money as well toward insurance for you in the event that you have to be out of work, not for a reason that is not work related, like you have to have your tonsils taken out, or you go skiing and you break your leg and you have to have a surgery and you're laid up for a while, or you have your wisdom teeth taken out and you have to stay out for 2 weeks because there's some complication or whatever it is. You are allowed to collect third-party sick pay, which is disability insurance, that your employers, and you pay in a little amount, but your employers paid the lion's share of this all year. And it's for a non-work related, illness or injury that requires you to be out of work and laid up. And each state has its amount per week that you're allowed to get. It's based on what you were earning at the time that that you go out. And that's disability insurance. Now, you're going to say, well, gee, if I'm out and sick and I'm laid up and I broke my leg, why do I have to pay tax on that? Because it replaces your employment income, doesn't it? If you'd been sitting at your desk or wherever you're working, at the waffle iron or wherever, you would have collected your pay. But they're being nice enough to say, gee, your tonsils had to come out. We're going to send you money anyway, just for being out. So you don't have to stand by the waffle iron, but you do have to lie at home recuperating, and you get an income replacement. That's why it is taxable. Now, this is a good juncture to say, why isn't workers' compensation on here? That's an injury, that's an illness, that could be something, I could be laid up due to something at my workplace. Well, that's not taxable at all. That's the deal that employers and insurance companies and unions and lots of other people have made with the government to say, if you're injured on the job or you become ill on the job, for whatever reason, it's a workplace event. Whatever you collect, a settlement, a weekly amount, both, if you have free medical for life on a workers' comp injury or illness, it's free. And we have people who come in and they're very upset because they didn't get a statement from their comp. And they said, I got $16,000 last year and I didn't get anything and I don't know what to do. We say, you don't have to do anything. It's free. It's free money. So you can thank your union, your employers, and your insurance companies for making a deal that said workers' comp is not taxable, but disability is. So prize winnings, lottery, jury pay, election pay. If you've been called down to serve, you're going to get your fast $60 or whatever it is. If you've served as an election inspector, if you've won the lottery, you notice they always, whenever people win the lottery, they always say, well, Mr. and Mrs. Bean took their check after taxes, right? Yeah, it's taxable. It's taxable income. Scholarships, awards, and honoraria. Most of the time, scholarships are not taxable. If they're spent on tuition and fees, you can forget about them because they're considered spent on your college education and they're not taxable as a result. But if you're getting a stipend, or if you're getting, when I was in graduate school, I had a research assistantship and I had a teaching fellowship, and I was earning money. They sent me statements at the end of the year, and I had some taxable income to report. Not a lot, but I had some. So we always look at that, and most of the time we don't see people getting too much in the way of taxable income from universities. We see people get scholarships, and it's on their tuition and fees statement, their 1098-T, and it says, the tuition was $5,600 and the scholarship was $5,000. The balance of tuition was $600 plus fees or whatever, and it's considered tax-free money. But we ask in the event that you do have a gig somewhere where you might be collecting an honorarium simply for being a smart and clever person, and they're paying you to do some kind of extracurricular work like teaching or seminar presentations, those kinds of things. All other income, it says, whether reported on these forms or not, bring it with you, because we don't know. I mean, you could have some form of income animal that we have not seen or that might be taxable that we just didn't put down here. Don't see it very often, but it could happen. The reason that we have direct deposit or debit information required or requested, I should say, is because we at VITA believe that if direct deposits of your refunds is the smartest, fastest way to go when you're e-filing. It prevents fraud, theft. It's secure, it's fast, and it's a smart thing to do. I know there are people who like to get checks in the mail, but the rate of theft and fraud with paper checks is enormous compared to with direct deposit. So it's just something we ask people to do, and we e-file everything. Let's go on the right-hand column. Medical expenses. Include all your ACA, which means Affordable Care Act, documents. This is very important. This year, last year we started with some new forms from ACA reporting, and those of you who were in the marketplace or the exchange, how many people purchased insurance on the exchange or the marketplace? Anyone in Los Angeles? Anyone in Chicago? No? We had just a few here in New York. Okay. If you did, you got something called a 1098-A, and you had to take it to your tax preparer, and if you didn't, you couldn't finish your taxes. Just couldn't do it because we need that form. Remember, Justice Roberts said this is a tax. So they've foisted it on us. So we have to help you account for your insurance on your tax return. So there's lots of reporting on all of this. This year, there is also a 1098-B form and a 1098-C form. Those will be coming later. Their due dates are March 30th. But if you have insurance, make sure that your preparer knows that you have health insurance and where you got it, how you were insured. If you have any of these forms, you have to bring them with you. Yes, did you have a question about the 1098s? You should get a form. The question is, last year if you had equity insurance, we didn't get any form. This year, you should be getting forms from all, whether it's the employer or directly from the insurance company. The B form is from the insurance company directly. The C form is from your employer. The A form is from the marketplace or the exchange, right? That hasn't changed. So be looking for those, but be prepared to tell your preparer that how you were covered for insurance, how many months you were covered for insurance, and through what, because it all has to be reported on the return.
What's 1098B again?
That's the one from the insurance company.
This form says 1095.
I'm sorry, 1095. I'm 1098. I'm still back in tuition and fees. Thank you. It's 1095. I apologize. Yes, 1095A, B, and C. Thank you. Medical and dental insurance premiums, you may deduct those. So don't forget to list them. Long-term care insurance premiums, for those of you who want care later and you want to be able to cover nursing home care, home aid care, and the like, long-term care insurance is a deductible expense. Put it down here. Medical costs, any co-pays that you pay, any out-of-pocket expenses for medical expenses, any transportation. So if you've got a regular gig to your chiropractor or to your PT or some other, kind of regular place where you're going, don't forget that, because it's $3 a pop. Or what was it last year? $2.75 a pop. But here, and your mileage in the auto cities is it can add up, especially if you're doing something every week, every other week, once a month, or whatever. You'd be surprised. And when we get to the auto worksheet, we'll look at where you put down your medical mileage, because it's an important addition and it can add a lot, an awful lot. Charitable contributions by cash or check. Get receipts. I know a lot of you do charities online. You want to contribute to the AIDS Walk or breast cancer or SPCA or whatever it is, whatever your favorite charities are, religion, education, arts. They will give you a receipt. They usually send you a receipt by email, or they allow you to print one as soon as you've finished your payment. Either print it out or save it to your hard drive, because if you don't, you won't be able to take the deduction. You have to have those receipts. And I'm telling you this in the event of an audit, right? It's always in the event of an audit. If you're never audited and you've killed a few trees, well, oh well, recycle the paper and sleep well. But if you are, you will need to have receipts for everything that you declare on your tax return. Just understand that. Charitable contributions in goods. Those of you who clear out your closets and take things to the Salvation Army, the Goodwill, whatever it is, you must also get a receipt if the aggregate amount for the year exceeds $500. So if you're just dropping a few things off and you get a receipt for them and you write a couple things down, it can't hurt. But if it's over $500 and you don't have the receipt for that tells us the name, the address, the items, and what the items were worth in a fair market value for sale in a thrift shop. Yeah, how's that grab you? So you've given away all your mohair sweaters and your Angora and your silk dresses and all kinds of beautiful, your alligator boots, so just great stuff, worth thousands, right? Well, what would they be selling them for? And if you don't know what those fair market values are, you may look them up online at the salvationarmy.org. They actually have a list of fair market values for thrift shop values. They're woefully out of date, but they never, they never redo them. I don't know why, but adjust accordingly. But you may use that in an audit. I've used it many times. Mortgage interest and property taxes are, of course, deductible. Why? Because Congress members deduct, the cost of their home in Idaho and their home in Washington, and the real estate taxes in Idaho and the real estate taxes in Washington. So you can deduct mortgage interest and property taxes, and because they want to encourage home ownership. The real estate lobby is very powerful. So, that's why those are deducted. Child and dependent care costs, so that you may work or look for work. Right? You're taking care of a child or a dependent person who is in your home. Could be a parent, could be a sibling, could be a spouse. I've had that situation a couple of times. And if you have to hire care for that dependent or that child, you'll have to get the name, address, federal ID number or social security number, and a receipt for the amount that you've paid. The under the table and the off the radar stuff, just keep it under the table and off the radar because it's not deductible. Alimony paid. Notice that those who receive it have to pay tax on it. Well, those who pay it get to deduct it. So isn't that clever and handy? Again, it's not child support. If you're paying to support your own children, Congress actually thinks that's a good idea and doesn't want you to deduct it. So, who'd have thunk? Yeah. Retirement, IRA, Roth, and SEP contributions. We ask about these things because there are a lot of people who supplement their retirement that they have being paid in by their union work, which is all employer paid. You don't pay into that at all. But you might have a 401k in addition. All right? You might have a SEP IRA. You might have a Roth IRA. So if you're funding your own ancillary retirement plan, or you're even doing it through an employer in a 401k situation, or 403b if you're in a not-for-profit employment, then we need to know about that if it is not evident on your W-2 forms or in some other statement. Usually you get statements from these qualified plans, so it's not a mystery to you, but there are valuable credits for middle-income people who fund their own retirement plans. Yes, you can get money off your taxes just for this. Total annual rent paid, we ask this question because in California and in New York and in New Jersey, well, not so much in Jersey anymore, a couple of other states, there are valuable credits and or deductions for people who pay rent and are middle to low income. And they're given a break on their tax return in the form of some extra money in their pockets. So that's why we ask what the annual rate is. It's your amount, right? It's how much did you pay in the calendar year in 2015. You put it on that line. Moving expenses, if you moved more than 50 miles for a job, you may deduct the cost of moving. It has to be for work. So if you move from New York to Los Angeles because your agent said, gee, you had a smashing pilot season last year, I just think you ought to move out and work with our LA office, and you go, yeah, great, I'm going to do that. And you do it, right? Or you're going to, you've had enough of pilot season, you're going to move to Chicago and work in the theater. You can deduct those expenses, provided that it's more than 50 miles. Now, if you're just moving around town, and it's easy to move more than 50 miles in California, but if you're still within what is considered the commuting range of your city, the city in which you work, in this case Los Angeles, sometimes San Francisco or San Diego, they won't give you the deduction because they say, oh, you're within a commuting range, right? You didn't really move for work because you're going to the same place, right? You could have moved more than 50 miles, but you're going to the same place to look for work and to actually perform the work. So bear that in mind. 50 miles is a hard number, but if you're still within a commuting area, they'll say, well, where do you go to work? So I still go to Los Angeles. And I say, well, you didn't change your work site, so we're not going to give you the move. You have to actually change your tax home, change your work site. Business and auto expenses we're getting to, travel expenses we're getting to, expenses related to investment income. If you pay a broker, an investment advisor, you can deduct those expenses. They're usually found on your investment statement or your brokerage statement. College tuition and student loan interest paid, I alluded to this. You want to make sure that you've got that 1098-T. There's my 1098 again. These forms, you can get very confused with all the numbers, but this is a 1098-T. We're going to need it if you want to have credits for college tuition. If you're simply taking coaching and classes to maintain your current job skills, you're not going to be looking for a tuition statement, right? You're just taking classes, and we're going to get to that when we get to your deductible business expenses. Student loan interest paid is usually found online because they rarely send you the statement, the student loan interest statement paid. So you're going to have to go online where your loan is held and pull that off. And we see people doing that in the hallway all the time because they say, oh my God, I forgot all about this. And they go online and they write the number down. And that's fine. We don't need to see the form, but you should know that you can deduct it. If you paid additional state taxes last year when you finished last year's return, right? You finished the 2014 return and you owed Connecticut $12 and you owed North Carolina $23 and you owed Detroit $17 and whatever it is, right? Don't forget those. They're deductible. They're deductible. It's not just what was withheld during the year on your W-2 forms, but what you paid over and above that. So don't forget those. That's why we ask about them. And if you're one of these people who pays estimated taxes because you earn most of your money on the 1099 area, or you're a private coach or teacher, or you have your own small business, and you have to pay quarterly, we ask you to organize those amounts because we're going to need to to reconcile those with your returns and give you credit for them. So we're going to need the exact dates and the exact amounts for those.